So the post-war consensus is largely American-driven. The 7-decade-long defender of the global trading system is the United States. And now it has a president who seems determined to shake things up, or maybe chuck the baby out with the bathwater. Is the world afraid he may actually do as he promised when he was campaigning? And what is going to happen in terms of investments? This is the Moneymakers, and those are the big questions, of course, I want tonight's guest to answer. Joined via Skype from Investec Asset Management by Chris Freund, who is the portfolio manager of the Discovery Balanced Fund, to talk about where money goes in 2017 with all the noise and all of the volatility. And Donald Trump, Chris Freund, has started with a bang, as he promised to do.
Absolutely, Bruce. You know, we all thought that, well, he was just a lot of bluster and a lot of big noise, but the regulation, the actual position would rein him in. But it seems like it's exactly the opposite. He started at full tilt, and maybe he will be as radical as we feared, quite frankly.
Fear? Express, just to clear that up a little bit more?
Well, I mean, I personally didn't believe he'd do half the things he was campaigning to do. But this, the Mexico war, is it actually going to happen? It seems hard to believe in today's day and age that it would actually happen. And then over the weekend, the shenanigans over the weekend in terms of, the Muslim ban on 7 countries is astonishing in my humble opinion. So we're going to get a hell of a lot of volatility coming from this man. And before you even ask, is it necessarily bad for business? Our answer is I don't really know. I mean, if it leads to an all-out trade wars between the major countries, I mean, that is bad. But if it's just, it'll be good at the margin for business, but bad morally what he's doing, I'm not so sure stock markets are gonna plummet on it, strangely enough.
Now, stock markets are notoriously unemotional. They look for the opportunity. Investors buy shares. They don't buy emotions. They sell on emotion, but they don't buy necessarily on emotion. They buy on fact. And if U.S. companies continue to do well, then the Dow, which hit 20,000 last week, the S&P 500, which went to its best levels ever, continue to grow as well. Indications are that markets will park whatever participants in the markets think personally about the president or his policies.
No, they'll just look at the economic effects. As you say, they won't look at the moral implications or the rights or wrongs of what he's doing. They'll just say, like, what are the economic effects? And if they're negative, they'll sell off. But so far, there's nothing obviously negative about the economic effects, except, as I say, if there's trade wars. If they really make life difficult to sort of trade across the globe, well, that's different. Then markets are going to come off.
Now, what are the odds of it? I mean, here we've got the threats of big tariffs being put on U.S. companies that try to import goods from Mexico, for example, or manufacture in Mexico and cross the border into the United States. Big threats to impose big tariffs on Chinese goods. That is the equivalent of a trade war, if it's implemented, is it not?
Yeah, but it's not widespread enough. I mean, it's been targeted at some specific companies. I think there were a couple of U.S. companies that sort of folded under a bit of pressure. The car manufacturing companies that sort of don't build the plant in Mexico, build it in the U.S. But I don't think that's widespread enough to sort of really constitute a trade war. It's when they sort of put up blanket tariffs against importing Chinese goods into the U.S. and the Chinese say, "Oh, fine, we'll do the same to you guys," etc. And so it starts. I think that's really, we haven't quite got to that level yet, in my opinion, Bruce.
I mean, there was something, I think it was way back in the 1970s, that's referred to as the chicken tax, because the Germans put a tax on American chickens, so the Americans put a big tax on German cars. And that led to massive protectionism in the United States, and the big boom that we saw in Detroit, and the proliferation, for example, of the Ford pickup truck in the United States. Some people would refer to that as something of an American success story. Detroit's had its problems since then, of course. A bit of protectionism, is it always a bad thing?
I guess not, Bruce. If you paint it like that, but it's in moderation. I mean, these trade agreements are negotiated over many years, and for him to all of a sudden come in and say, "Oh, sorry, I don't regard it as fair. We're just going to tear up the treaty," just doesn't seem to me to be the way that a large economic powerhouse in the world should go about their business.
Does it change the way you think about investments? I mean, South African investors have done very well in the United States in recent years, courtesy of a depreciating currency, appreciation of the value of American companies on the Dow and on the S&P and through the NASDAQ as well. South Africans have done very well through that trade. Is it over?
Well, look, personally, I think that the US market is one of the most expensive markets in the world. I'm not a value zealot, so I don't think value is everything. But it's difficult to argue the US market is cheap. Secondly, the US economy, irrespective of Trump, is further ahead in terms of the business cycle. And they are entering what I would call very squarely late cycle economic territory. And hence you've got the Federal Reserve starting to put up interest rates, or has for a while, but it's going to, I think, put them up a bit quicker this year, as does the market, by the way. So, lousy valuation, you're fighting higher rates as the year progresses, and you're very late cycle territory. I think there are better offshore opportunities for South African investors. In Europe, for example, in the discovery funds, we have an overweight position in European equities broadly. We have an overweight position in Japanese stock market, and actually quite a severe underweight position in the US market.
But aren't both Japan and Europe heavily dependent on whether or not the US flies? If the US goes into a bit of a post-Trump funk, then Europe and Japan will catch a cold, won't they?
Yeah, I mean, I think it will impact them to a degree, but I don't think US is going to go into a post-Trump funk, actually. I think if you look at the economic data, it is quite strong. If you're suggesting that Trump will do something really radical just to sort of stop the upswing in its tracks, I'm not sure. Yes, I guess there would be a global knock-on everywhere. But I think the internals in Europe alone are improving. I mean, the European data is looking better than it's looked for a very long time. Look, it's still Europe. It's not growing, by Asian 5-6% standards, but it looks like to us Europe is going to grow by sort of 2%, 1.5 to 2.5%, which is a big deal. And then Japanese companies are starting to do better as well. So yes, I'm sure there will be a knock-on effect, but if the US falls in a heap, but just not what we think is going to happen.
I mean, we look at, for example, our relationship with China, the BRICS countries. Russia's got its issues. India is growing very, very nicely. Brazil, of course, has had a torrid couple of years. And China seems to be looking to fill a gap, maybe a void that Donald Trump could see the United States open and vacate maybe for the Chinese.
Now, isn't it ironic, Bruce, how China is almost perceived to be the bastion of free trade these days? Well, I mean, that's not quite correct. If you look at China's economic history, it's anything but, free trade. But relative to the noises that are coming out of Trump, absolutely. And China has been trying to sort of put flags in most of Africa for the last 20 years in terms of its commodity requirements. So I'm sure that won't stop. We'll build a sort of bridge or a hotel or something for you as long as we can get your copper exports or your nickel exports. So that's definitely going to keep going as well.
Where does it leave us sitting down here at the southern tip of Africa? We've got the JSE, which has had a pretty good start to 2017, up about 5% after a very flat 2016 and a marginally positive 2015. Finally, there's a bit of life coming into our market, bit of currency strength, a little bit of optimism that 2017 might not be as atrocious a year as 2016 was, certainly politically.
So I'm in that camp, Bruce. I think 2017 is going to be a much better year for discovery clients, in fact, for all investment markets. There's going to be volatility. It seems like within South Africa, the sort of dark forces are rallying their troops behind the scenes, and I'm sure we'll get some political shenanigans coming out soon. But cast your mind back to last year. Yes, there will be some interesting headlines this year, but I don't think we're going to get the seismic shifts, both in South Africa and globally, that we had in 2016. So I don't think the volatility, we're not going to get the sort of a Trump Brexit type volatility internationally. I don't think we're going to get, Pravin Gordon's about to be fired in South Africa. Now, I might be being naive, but I don't think so. And then globally, as I said to you, there's a sort of a mild economic upswing happening. So there is a risk, and it's an upside risk, in fact, that markets do very well this year. It's not our base case. Our base case is that we make quite a lot of money for our clients, but not, eye-watering amounts. But there is a risk that markets take off properly in what's a normal late cycle surge before central banks have properly taken away the punch bowl.
So, okay, what's in the punch bowl then? I'd like to know, please. What is what is part of the cocktail that is going to drive growth on this market in 2017? Let's go local.
So the punch bowl remains very low interest rates. All right. So that's good unequivocally for sort of capital markets, and they are going to be quite cautious about hiking rates around the world. In South Africa, by the way, the punch bowl gets better from that perspective because it's our view that they're going to drop rates in South Africa. The Reserve Bank is going to start to hint to the market in the second quarter of this year, which is not far away, that they are getting ready to drop interest rates in South Africa in response to plummeting inflation, which is 6.8 and is going to go to somewhere near 5% within 6 months. So that's good for markets. And then I think personally our growth rate in South Africa is going to improve off a very low level, albeit because of things like improving agriculture, with the drought being less severe this year, improving tourism, improving manufacturing sector in a delayed response to the significant rand weakness over the last couple of years, and improving sort of commodities sector in response to the improved commodity prices of last year.
That's a very nice fudge, Mr.
better.
Freund, but I need a stock from you, at least one. You've got me down from 3 to 1, but I'm going to take one. I'm going to get one out of you no matter what happens tonight.
I mean, we've got a lot of stocks we like in our portfolio.
Give me one.
I tell you one which is not on everybody's radar, and I think we're going to make a lot of money for our clients the next couple of years, and that is a stock called Tongaat. There's a sugar rush coming from improved sugar volumes, and there's also property sales which are at a low, which are going to, I think, improve quite materially over the next couple of years.
At that point, we're going to leave it. Chris Freund, Portfolio Manager at the Discovery Balanced Fund. He is our guest this evening. More Trump trading, Trump Madison, a touch of Trump toughness. Boy, you can't say too many T's at once at this time of night. Chris Freund at Investec Asset Management, running the Discovery Balanced Fund. Thank you very much for joining us this evening, and thank you for watching. Till next time, bye-bye.